It's down to you.
Welcome back to Switzer. Playing a stock market like this one is always easier if you are given guidance from old hands or old heads who've seen it all before. But have old hands such as Roger Montgomery from Montgomery Investment Management really seen a market like this one? Let's find out for the man himself. And when I wrote that, Roger, you probably said, I'm not that old, but you've been around a long time.
Yeah. 23 years.
You had to start when you were at 10, did you?
23, well, 1980, what was it, 1988?
Okay, that's all right.
Or thereabouts.
Yeah, you've seen plenty of markets.
Yeah.
Do you think you've seen a market like this one?
Yep. And
when?
The last time I saw a market like this was the tech wreck, before the tech wreck, and just after the peak. What we're seeing, Peter, and what Australian investors need to understand, so we're not talking globally here, we're just talking about Australia.
For those who play in the local market, you're saying?
Correct.
Okay.
Is China is slowing down at a rapid rate of knots, which is affecting our resource sector. And then we've got a massive banking structural problem in China, which will affect our financial sector. And so both of those two things combined means that the resource sector is going to suffer further losses, and I'll explain why in just a moment. And the banking sector, for domestic reasons and because of international influences, are going to suffer as well. And that makes up a very large part of our ASX S&P 200 index. And so that's why I've been more cautious and less bullish than many other analysts about where the index is going to go over the next 12 months. Okay.
So when you look at banks at the current prices, you don't say they look like good value at these prices?
No, I think it's true that the share prices have dropped, but their earnings outlook and their prospects over the next 3 years is not as bright as it once was. So
is that because of APRA and David Murray?
Partly.
And partly because of China's growth as well.
And partly because of sentiment towards financial services as a result of the structural issues in the banking system in China. So when we looked at the quarterly results of the regional banks in China, what we discovered is that their non-performing loans over the last 3 years are flat. There's no deterioration in non-performing loans.
That's not a bad thing, is it?
No, it's not. But they've got a new classification called special mention loans.
There's like crappy loans.
They're up fivefold in the last 3 years. So it's a bit like, not completely, but it's a bit like the subprime crisis, but in China.
But Roger, are you saying that there's a Chinese bank, Australian bank connection?
I'm saying that there's going to be a negative sentimental shift towards financial services as the banking crisis in China unravels. And no one's talking about this at the moment, but it's very real.
It feels like it's like a repeat of, because there was a US banking problem.
Exactly.
It all became an international banking problem.
I remember driving out of the studio and talking to another network on the phone during the bottom of the GFC and saying our banks are being treated like US banks that are being nationalised, going out of business, but our banks are making billions of dollars in profits. That's wrong. You should be buying them. We will get that opportunity, I think. And so that's why I'm not as bullish about the banks at current prices. I also think there's going to be pressure on the regional Australian banks on their net interest margins if interest rates come down further in Australia, which I think they will.
What about economic growth in Australia? If it turns out to be better than, say, you're expecting, let me ask you, for example, let's go...
So it has to be hypothetical because Australian growth will not be better than expected.
Yeah, okay. Let's go 2016, 17, because this year to me is going to be in the twos.
Right.
And we might, in the last quarter of this one, we might go high twos. But at the moment, I've seen Reserve Bank forecasts and other private bank forecasts having us climbing into 3.5, 3.75. I think even a budget forecast had that in 16, 17. If that comes about, then would these bank
at
share
these prices would be fine.
Yeah, because we have good growth and interest rates will start to rise and banks will do well. So the critical thing for you and for people making decisions is that high growth possible? And
so
your
let's
point
talk about that.
No.
Let's talk about that briefly. So on the resource side, so take iron ore for example, what you've got is you've got companies like Vale, ArcelorMittal and Fortescue Metals Group that are highly leveraged, negative free cash flow, and the commodity price is dropping. Now, when you're highly leveraged...
I'm thinking desperate here as you say that.
When you're highly leveraged, you've got to sell more of the commodity at the lower price in order to meet your interest expense. So they're incentivised to produce more iron ore at lower prices, not less. So that's the resource sector. That's telling us that coal and iron ore is going to fall further. BHP came out with their results last week, and their cost of iron ore production is now down to $15 a tonne. So they're incentivised to produce more at $55 a tonne. They're going to keep producing. You asked about the economy over the next 2 or 3 years. In 2017, there will be no automotive production in Australia. 50,000 people employed directly and indirectly in that industry. That manufacturing, part of the manufacturing industry in Australia is going to be hollowed out in the next 2 years. So that rules out resources, that rules out manufacturing. Then what's left? Construction. So we've got record approvals, we've got record commencements, and we've got record completions, but we've got declining population growth. And I was just over in Perth yesterday and the day before, and they've got negative population growth and record approvals, record completions and record commencements. Those 4 things don't stay that way. When you've got negative growth in population, which they have, and we've got declining rates of population growth on the East Coast, you can't continue to have rising property prices. Property prices are capped.
So you're thinking that when you put those components, and that these are the drivers of economic growth, they're not offering you the expectation that 2016-17 will be as good.
No, I think we're going to have rate cuts. I think we're going to need rate cuts, and I think the world is going to deliver on us a verdict on our uncompetitiveness, which is a much lower Australian dollar.
Yeah, I was going to say that. Now, the interesting thing about that is it's a punishment, the dollar comes down, but it's also a great stimulus for growth in itself,
Correct.
isn't it?
Well, when you've got an uncompetitive labour force, which ours is because it's unproductive and it's expensive...
won't like you saying that, but go on.
Well, I don't care what the politicians say. The successive governments in Australia have got us into this position. What have they done, Peter, about replacing the industries that are now being hollowed out? You know, I had breakfast with Andrew Robb, a year and a half ago, and I said, Andrew, what are you going to do? And he said, we're going to focus on our strengths, Roger. And what are they, Andrew? They are resources and agriculture. I said, give me a break. I mean, we're price takers. Then we have no competitive advantage in those things. We are price takers. Whatever the global price is, that's what we get. So what have successive Australian governments done about replacing the industries that are being hollowed out? Nothing. So I have very little respect for them at the moment.
So tourism education is not going to be...
It's not going to fill the gap. It is not going to fill the gap. What they need to do is they need to give startups a tax holiday so the market can decide what we're good at, and then they can come in over the top and start subsidising things that we've got strength in. But that's aside. So where we're left with is we've got some businesses in Australia that are doing remarkably well overseas and locally. Companies like Challenger in Australia, Isentia growing overseas in Asia.
So both those companies you still like?
Love them. Think they're cheap compared to intrinsic value. Isentia is a case in point. Growing its number of clients and growing the average revenue per client as well. In Australia now they've got their average revenue per client up towards $34,000 per year per client, and in Asia where they've just launched it's still sort of $11,000 or $12,000, and there's much bigger companies in Asia who want their services.
Is Challenger going to benefit from lower interest rates if your interest rate call is right?
I think the way they're pitching their product, which is a steady, stable income stream through your life without worrying about the volatility of the stock market, will work.
Roger, but that works against brilliant funds like yours.
Well, look, there's room for everyone.
Okay, mate, we're out of time, unfortunately.
Thanks, Peter.
Thanks for coming on the show.
Pleasure.
That's Roger Montgomery, of course. So that's the show for this week. Thanks for joining me. I'll see you next week, and don't forget, Best of Switzer over the weekend. It's on Fridays as well nowadays. See you then.